Several years ago, I developed a thesis called the Everything Code. The Everything Code is my all-encompassing macro framework that I've built over the last 35 years that builds upon the giant demographic trends, how that leads to a growth in debt, where the entire Western world plus China and Japan have been involved because of the same demographics issues, and how that debt is managed by the debasement of currency and liquidity in order to roll the debt, and how the debt is cyclical. It's generally between a 3-year and 5-year time horizon, and why that causes the economy and markets to be cyclical, including crypto, and how to navigate it and how to get forward read on it. And a forward read on it, we use things like the Global Macro Investor Financial Conditions Index, leads by 9 months. And we also use the Global Macro Investor Global Liquidity Index, which leads by about 6 months. And those things, in combination with M2 and our other indicators, give us a really decent probabilistic read on how things play out.
Bitcoinzilla stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now, guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoinzilla today and enjoy the new edge.
Raoul Pal explores gold, tech, Bitcoin. We'll cover cycles, strategies, signals, risks. Stay tuned to level up your investing today.
Now, we are kind of pioneers of this whole structure, but there's one other person that you know well who also looks at the world through a similar lens. Now, it's not quite the same, but he's truly a pioneer in this kind of debt cycle analysis and global liquidity, and that's Mike Howell. And Mike is always a firm favorite when he comes. We swap notes, talk about what we're seeing, what he's seeing, and as ever, I think you're going to love this conversation. It's going to give you a really good idea of where things are headed, what the structure of liquidity is, what it means for markets, and what it means for your bags. The other thing, so just zooming in now, is we use our financial conditions index as a lead on total global liquidity. And it has been sideways for a while, but it looks like it's about to expand again because it's the dollar, interest rates, and all of those seem to be moving in the favor of that, which then gives us a longer lead on the cycle. So I'm trying to get your thinking on, okay, what does the next 3 to 6 months look like on a forward basis from what you can see from liquidity?
Okay, I mean, my view is, I'm not bearish on liquidity over that time frame.
No.
I think that there are a number of questions that people will raise, and I think one of those, and I'm going to show you another chart, hopefully if this one works, is what's happening to the Fed balance sheet. So that's number one. And this is looking at a concept that, I call Fed liquidity, which is the thing that I came up with, when I wrote that book, Capital Wars, which is looking at, the various components that the Fed uses to get liquidity into the system. Now, that's clearly an important element. It's not the whole story, but it's an important element. And what this is basically showing is that if you look at the projection period, on paper, the growth of Fed liquidity falls and goes negative. And the reason for that is if you come back to the underlying ingredient, which is US bank reserves, this chart is showing our projections through year end of US bank reserves based on...
Yeah, everyone's getting really caught up on this because they're like, the reverse repo is empty, and therefore, if you rebuild a TGA, you've got a massive liquidity shock.
Yeah. So, the question is, number one, will they rebuild the TGA? Well, okay, if you look at the quarterly refunding announcement, it says they're going to go back to 850. Well, I would be staggered if they get there, because to take that amount of money out of money markets would cause the repo spread to spike. And I don't think they want to do that. There's every indication they're trying to manage the repo spread. So I don't buy the fact they're going to put it up. Even if they do put it up, you can find other ways of injecting liquidity, as we said, through Treasury QE or getting the banks to buy debt. So I think there are other ways around it. But what that chart is trying to illustrate is that the dotted line, the red dotted line, is my estimate of what adequate reserves are, minimum reserves in the system. And it looks as if there was that step change back last August when you got the change in the stress test rules. But basically, what's happened to bank reserves through this year is they very closely hugged to that dotted line. And I think that's deliberate because, as we know, the Federal Reserve controls bank reserves in aggregate completely. And I think that's what they're targeting, amongst other things. So to see that drop off, which is the TGA rebuild prospectively, I just don't buy. I don't think it's going to happen. So I think that number one is you've got still pretty decent Fed liquidity. And everything that I hear Scott Bessent say and what I see the Fed doing is they want to manage that liquidity. They don't want to pull the rug from the markets. Why should they? Number one. I think if you look at offshore markets, or in other words, international markets, I think that Europe continues in the groove it's been doing, which means adding more liquidity. They're going to have to do that anyway. And I think all the moves are towards more ease in Europe. Japan, I think, follows because they want the yen to remain soft. And China is embarking on a major monetary expansion. So as far as I can see, the liquidity background still looks to be pretty benign over that time frame.
Bitcoin just printed a daily MACD golden cross for the first time since April, and traders noticed. Back then, the same signal came before a 1-month rally of about 40%. If we apply that move after the September 5 cross, the roadmap points toward $160,000 in October as long as momentum plays along. Why it matters is simple. A golden cross below the zero line often marks a reset or a tiring downtrend flips into new energy. Since the cross, mood has improved and buyers are leaning in again. Technically, the setup looks clean. The MACD line has pushed above its signal line while still below zero, a structure that can drive follow-through if price holds higher lows and volume expands. Brief dips into support are normal, but steady closes above recent highs keep the $160,000 target alive. Macro helps too. Softer inflation has lifted risk assets and gold. Another friendly CPI could add fuel. Nothing is promised, but the checklist says upside is back on the table. Watch October closely.